other than the identified cost method, the other way to value inventory is using the FIFO method. So let's explain what that is. So a business had the following inventory card. So we've got a few items there. But at the end, the balance shows 5 units at $300 for a total of $1,500 and 10 units at $280 for a total of $2,800. And the question then becomes, well, if we sell 6 units today, which 6 units were sold? And we looked at with identified cost, we would actually have stickers on these so we could tell at the time of the sale which one was which. However, sometimes that's not possible. So we will use the first in, first out method, which we'll call FIFO. And what is that? It's just an assumption. That's the important thing to realize straight away. It's just an assumption. And that assumption is that the first items in are the first items out. So it may not be true. It's just an assumption, but it's good because we actually then don't have to identify each individual unit. So here's our what we had. We had 5 at 300. They came in first, and we had the 10 at 280. So this time if a customer wanted 6, we would assume the first 5 were from the 300 pile because they came in first. So we've got 5 times 300 is 1,500, and these are all gone. And then we'll assume if these are the order that they came in, this one here is the first one in that pile. So the customer took that one. That's 1 at 280. For a total of 280. So the total cost of that sale is $1,780. However, that's probably not 100% correct, but it saved me the time and the effort to find the exact cost, and that's why it's really useful. What type of inventory would this best be used for? Well, some things you could use it for would be like fruit and vegetables. You can see how many there are and how they're stacked. Kmart, because it's got so much stuff. Same with Officeworks. Or petrol. Why? Oh, sorry, what wouldn't you use this for? You wouldn't use it for big things like a car yard or a place that sells mattresses or guitars or furniture or boats. So why use it for the ones on the left and not the ones on the right? Well, it's because the ones on the left are faster moving. So as in there's a lot of sales of these every second of every day. So for all these businesses here. Also, some of them are perishable, so it's probably a reasonable assumption to assume that the first tomatoes in are the ones that get sold first, because the older ones get moved to the front by the business because we want to sell them before they go off. That's called perishable. It's also really good for things that are physically smaller. Like we said with the identified cost, you've got to put stickers on. How would you put a sticker on something where it's not physically possible to differentiate or identify? How would you put a sticker on like a tomato or a carrot? Or maybe at Officeworks, how would you put a sticker on a pen or an eraser or a sharpener? And you physically cannot do that for petrol. So that's why it's good for inventory that has these characteristics here. Let's look at the real beauty of it. What about when the business has lots of inventory? So let's just take an example here. Let's assume on March the 1st, the firm buys 5 units of stock at $300 each. So that's an in, and there's our balance. Then on March the 2nd, the firm buys 3 units of stock at $290 each. So we've got 3 in at $290. And now we've got 5 at $300 and 3 at $290. And then on March the 3rd, we buy even more. We buy 7 units, and this time they're $310. So we've got our 5 at $300, our 3 at $290, and our 7 at $310. So let's metaphorically assume there they are. We've got the 300s here first, then the 290s, then the 310s. Customer comes in today and buys 1 unit. Which unit do they buy? How can we tell? Well, it's actually quite easy to see on the screen here because they're all different colored and stuff, but that's not the way the world works in business. So the issues we have are there's too many of these to put stickers on. Like I've just done what's that, 15 units. We could have 1,000 units. You wouldn't put stickers on. It's not practical, it takes time, and it doesn't look good either. So that's another reason not to do it. However, they're probably not stacked neatly. I had them in nice, neat, color-coded piles. They're probably all over the place. Like imagine Officeworks with pens. Like they're not stacked neatly. They're all over the place. I think the other thing to realize is they're not all different colors. They're all sort of the same color. They look identical to the customer. The customer doesn't know which one cost what. And lastly, they don't have the price on them. They're just boxes or a product. So now when the customer comes and grabs, let's just say that one, which one was it? I can't remember. And the thing with FIFO is we don't need to remember. It's really not important because what we're going to do, we're just going to say for some types of inventory, it's too difficult to identify the individual unit. So we'll just make an assumption. We'll assume this. The inventory is metaphorically stacked in date order. It's just a metaphor. It's just an assumption. What do we mean? Well, on March the 1st, we bought 5 at 300. So they're there. Then we bought on March the 2nd, 3 at 290. They're there. Then we'll assume on March the 3rd, we bought 7 at 310. They're there. And that's how it will go on our inventory card. Okay, the oldest one's on top, then the yellow ones, and then the last one's in with these ones. Customer comes in today, and we will assume as the inventory leaves, the first one in is the first one out. So let's say this customer comes in and says, 3 units please. Which 3? I honestly don't know. I can't tell, and it's not important, but I will assume it's these 3 here. So that customer is going to take those 3, and then I update my inventory card. I say the 3 that went out were the $300 units. I update this. There's not 5 of those left now. There's 2 of those at 300, so there they are. There's 3 at 290 there, and I've still got 7 at 310. Easy. Then another customer comes in and says 4 units please. Which 4? I have absolutely no idea. It's not important, but I'm going to assume it's this one here, this pink one, and that pink one there from March the 1st, the $300 ones, and then these 2 on the top of the March the 2nd pile. So the customer, I'm going to assume, took those ones. So I go to my inventory card, and the out I do, there's 2 at 300 there. So now they're all gone. There's no more of those left. That pile's gone. In reality, look, there might be some $300 ones left, but it's not important to me. I'm going to assume that 2 of the units that customer took were $290 units. So now that leaves just 1 at $290 there. And I've still got all 7 at $310. I mean, that's probably not true, but it was easy to figure out. Then lastly, another customer comes in and says, I would like 2 units, please. Well, which 2? I have no idea, but I will assume this one and this one, because they were the first in. So the customer took those. I'm going to update that inventory card. The customer took 1 at $290, and now they're all gone. There's none of those left. And I'll assume the customer took 1 at $310, so now there's 6 of those left, which matches my pile here. And it's almost certain that the 6 units left weren't all $310 each, but that is what I will assume. It's not 100% accurate, but it saves me time and money. So to discuss this, we can say, look, there's some really good things and some bad things about the FIFO method. Let's start with the good things. The advantages are it saves time and money. We no need to calculate the exact cost of each transaction. We can spend time and money on more important things. We've got more important things than to figure out which pen someone bought at Officeworks. It's practical. It actually might not be possible to identify the actual cost of stock sold. For example, petrol is not physically possible to label it, and Kmart, there's too much stuff, or Officeworks. It's not possible to or practical to label everything. Thirdly, it's all going to balance out anyway. The cost of sales will balance out, because when you think about it, if I sell everything, well, all the costs are going to sort of go out. The order is not really that important. If I sell everything, it sort of balances out anyway. I'm just changing the order in which I assumed it was sold. And lastly, it increases net profit in the short term. That's when inventory prices go up. We'll talk about that in a separate video. That's hard to understand. We'll come back to that. Well, what about the bad things? The bad things are this. It's inaccurate. It is literally not meant to be accurate. Okay, so we can say a disadvantage is it's never 100% accurate, so that does not fulfill the faithful representation test. It's not, a real world, doesn't represent 100% the real world economic situation. What else is bad? It limits your decision making, because we're going to assume the first in is the first out. Is that actually how you wanted to sell it though? Maybe for some reason we don't actually want to assume that the oldest stock was sold today. And lastly, it's the opposite of this one. We said FIFO increases net profit in the short term. It actually decreases net profit in the short term when inventory prices go down. And again, we'll have a separate video to explain these last 2 points there.